Good afternoon, Quasar Markets Live. I mean, this guy needs no introduction at all. Jim Iuorio, University of Illinois, Chicago, Windy City. Everything's going well for you, including your Bitcoin. How you doing, man?
I'm doing good. I'm doing better because Bitcoin's shot up like a rocket today. So yeah, I'm feeling pretty good today. Copper is another one of my longs too. And a couple days ago, copper shoots higher, but it's not for any reason that I thought it was going to shoot higher. So it's almost like, don't get me wrong, I'm going to take the money, but it's almost like there's some guilt involved. Like, yeah, I didn't predict that, but okay, I'll take it. But the Bitcoin thing is an interesting trade, as you point out. Yesterday morning, I put out to the subscribers of the Unfiltered Investor that if it trades 110,500 or 111,000, it was breaking out of a 2-month consolidation pattern, was going to head higher. So that's the technical thesis on the short end. The fundamental long-term thesis of mine has never changed. And that's one, it's broad adoption. BlackRock, United States government, El Salvador, those are all, when those places are broadening their footprint into the space, it's something that I want to be involved in. And if you can make the argument that it's a hedge against poor stewardship of the dollar, poor stewardship against currencies in general around the globe, sign me up. That's what I live for. That's what I'm looking for, are things, because I have zero confidence in the stewardship of our currencies. All that makes sense?
When I look at the markets in general, and I have to take it from a broader perspective, I'm not just the person who grabs my charts because I love charts. I've been charting for 34 years, but I have to look at the bigger picture. And one of the things, Jim, I know that the market hates is not having clarity. And we've talked about this in the last couple of shows, that we're not seeing clarity. And I felt over the last few weeks before this week that clarity was coming in. And then all of a sudden, the president shoots out all these letters. Navarro says, oh, it's just a negotiation tactic. You all know that. We do. And there's no more clarity again. So all of a sudden, these commodities that you're talking about, and whether it's copper or crypto or Bitcoin or oil's not doing its thing, but obviously gold is. Talk to me a little bit about this administration. Do you feel like we can put some faith into the administration that things are going to get done, or are we back to hedging again and protecting ourselves?
I think we're back, because if you look, VIX is somewhat elevated this year. It has been, not hugely elevated, but it does smack to me of people who are hedging their risk a little more closely than they've done in the past. I'm doing that more. Even today, when the S&P started to break out to the upside of a pattern that I love, and I was long for it, but as it broke out, I even put on more hedges because it hit my change on a couple day period threshold to put on hedges. So I am being cautious about this rally, but I am long. Now, you said all the uncertainty, and I thought 2025 was going to be a tumultuous year. You don't go from a system of government, the fiscal economic side of it that we had for the last 4 years, to what we're trying to get to and have it be a smooth and elegant transition. Regardless, I don't care if you think we're going from bad to good, from good to bad, it doesn't matter. Transitions by themselves are hard. Now, the fact that the stock market's going so much higher, like screamed higher, I think it has 3 components to it. On April 8th, when it hit the deadbeat low, that was the most emotional, nonsensical sell-off I've ever seen. It was just this crazy Chicken Little, the sky is falling, sell everything. And that's not just me saying it. I polled like 200 different money managers who said those were the calls that they were getting. So all of a sudden, boom, it starts to bounce back from that. Then all of a sudden it turns into a short squeeze. Then it makes new highs and the FOMO trade starts to kick in. So that's all why I think it's rallying. Now you can throw in the fact that M2 money supply is still going through the roof. Now, some real wonky analysts will say, yeah, that's because of pull forward and cash and inventories from worries about the tariffs. And that might be the case. But then you look at the Fed's balance sheet. Now, I don't want to get too wonky, but they were draining their balance sheet as part of quantitative tightening. It seems like they have at least not quite stopped, but stalled to that. It's almost a flat line, which to me, that means the quantitative tightening is over. So to me, the easing cycle has almost restarted, but it hasn't restarted in the Fed funds rate that we're used to seeing it. So all those things are supportive of stocks. Am I talking too fast? Am I throwing too much?
No, I think it's great. What's interesting, Jim, all the things you just said, I was on Roxham TV just 2 minutes ago, but I think you were on Schwab saying the exact same thing.
Exactly.
That's exactly right. I think that people like us who have been in the game a long time are not FOMOing. We're not memeing coins. We're not doing all the craziness. And we're the ones, I hate to say it, but we're the adults in the room going, when that sell-off happened, you and I talked about this. I threw the kitchen sink in. I was like, that's capitulation. That's pretty much the very definition of it. And I was on a show that people were screaming and crying and wailing and gnashing of teeth, the world's going to end. I was like, no, I'm buying. Thank you for telling me the world's going to end, because that's when I like to buy.
Yeah.
But here we are at the top now. And I want to be that ticker taker saying I want to sell, but right now I don't feel like I want to sell the crypto yet.
Okay, so even from a technical standpoint, is that it's above the 200-day, above the 50-day, the 8-day and the 21-day, which are two of my favorite metrics, are still widening with the 8-day leading the way, meaning short-term momentum on all levels is pretty good to the upside. The one thing, when the 8-day and the 21-day get fairly far spaced out like they are now, oftentimes we have a little bit of correction. I think when that correction comes, it only goes back down to about 6,000 or so. I don't think I'm a bull. And again, like, let's look at just the last spending / tax bill. Cut taxes, not very much. We cut taxes though, some. We're still spending like drunken sailors, which supports the market, whether we like it or not. And then you throw in the fact that there's really, really a strong push for deregulation. Well, that's not a bad long-term recipe for stock gains. So I like this rally.
And I can't disagree with anything. I like disagreeing sometimes with some of my guests, and everything. We're all on the same page here, which makes me nervous though. When everybody's on the same page, there's got to be someone out there. Now, we just saw.
That's why God invented puts, though, Stephen.
I couldn't disagree with you on that either, right? I will say this much. I have had 3 guests on the last 2 days. Scott Bauer, I've had some people that talking about one thing and one thing only: volatility. And you just mentioned that. The VIX itself under 16 is always a buy for me. Volatility seems to be fairly low here. Is this the time to buy volatility to protect yourself?
See, when the VIX is trading around 14 to 12, that's when I start putting on naked puts. Anything above that, I usually tend toward put spreads, just because it's a little more expensive than normal. Again, volatility is historically low, like you said, but for all-time highs in a market that's had a 3-month one-way street higher, it doesn't seem like it's quite low enough to where it should be. When we've seen all-time highs in the past and a market that's grinding, it usually seems like it should be around 13 or 14. It's not. So I put on put spreads. I don't sell calls. It's not rich enough for me to sell calls. I am short some from before, which is part of a whole different thing, but I'm not initiating any now.
And when the second question most people ask about the options is timing, right? So what do you have on timing? I'm hearing September. I saw Dan Niles in New York a few weeks ago. He said Thanksgiving is going to be a rough Thanksgiving. And we're seeing from Stifel saying, look, the market's going to take a dive 10-12%. But Goldman Sachs, JP Morgan are on the other side of that trade saying we're going higher, way higher. The S&P calling way higher, like 20-30% higher.
So when I put on my options duration, I pick the duration, not necessarily from when I want to pinpoint when things are going to happen, just based on a kind of a decay mechanism. So right now I have to September, but in about a month, before they start decaying rather quickly, I'll probably roll them to further out, because I'm not good enough to pick when it's going to happen. Do I think we're stretched? Some technicals are telling me we're a little stretched on the short end. Nothing hugely stretched on the longer term, but that's why. So I have September options now, but I'll roll them past Thanksgiving in about a month.
And for those of you who don't understand what he's talking about, is that when he picks a month and it's getting closer to the end and it may not be where he wants it to be, he can move it to the next month, September or October, or depending on the commodity, that he can roll that option over to as well. All right, Jim, I have to ask, I've heard several people talk about it, and you're in Chicago. That S&P pit is, it's right next to the VIX pit. Are those boys talking to each other? Are they having a conversation, or are they fighting down there again?
I don't know. I think they're fighting. I'm not sure. I'm mostly in the interest rate pits. I don't know what those guys are doing. They're upstairs from us at the CBOE, so I'm not exactly sure what they are doing. I don't talk to those guys a lot, but I do think that probably they share a lot of what we're thinking now too. Bullish, but a little bit scared.
All right, I'm gonna look at my screen here. 10-year now sitting at around 4.348 as this slippage a little bit more today. That means that the bond market doesn't need to raise rates, right?
Well, no. So here's something really interesting happened. I think it was Tuesday of this week, with the day that Donald Trump screamed, lower the rates, which, by the way, I agree that that rates should be lowered right now. I do think there's a couple things that indicate to me the economy might be slowing, but I hate the way Donald Trump does it. But here's what I was going to say. When rates were lowered 50 basis points the last time, what happened to the 10-year yield? It went higher, meaning the bond market was saying you probably shouldn't have eased. You weren't ready yet, and there might be some inflation because of it. Well, 2 days ago when Donald Trump said it, short-term rates went lower, 10-year rates went lower. Not a lot. They just went a hair lower, but they didn't go higher. To me, that was a little bit of a wink from the bond market saying, okay, we are okay with a rate cut now, and we won't view it as ridiculously inflationary. Because I think the market has begun, the broad market and analysts themselves are starting to realize that the tariffs are not as inflationary as they were originally projected to be. And, I've been beating that drum for quite a while, and which is ironic because the one tariff that does seem like it could be inflationary, the copper one, happened this week. But I think that we all believe that that's probably just bluster. We import half the copper that we use and cover the other with domestic copper, and we don't make enough copper to do it on our own. That would be inflationary if that stays in place.
Yeah, you talk about copper, you talk about rare earths, but all of this is to me, I think, is noise on the outside. When it comes down to it, I think the biggest question I have to ask you, and I've been asked myself, is the biggest question whether or not Donald Trump keeps the Fed chair, Powell, or does he replace him soon if he doesn't get his wishes?
I think that's a huge question. And I already think we're starting to see mutiny within the Fed of people aligning themselves, either aligning themselves with whoever's going to be the new Fed chair or posturing to get that position themselves. We all know who I'm talking about. And they dissented and they said they thought we should be lowering rates a lot quicker. I do think Powell's going to lose his job. And I think someone's going to be put in who will lower rates. Again, I can't stress this enough. I hate the fact that Donald Trump is right on this. Again, I voted for Donald Trump. I'm not a big Donald Trump supporter, and I don't care who knows it, but I don't like the way he goes about doing things. It's made very unprofessional to be hitting Jerome Powell over the head with a sledgehammer all the time. That being said, I hate that I agree with him. I do think, the real estate market seems to have turned, and that doesn't show up in the CPI for 6 to 8 months. Just last week, I thought the labor market looked pretty ugly, and everyone agreed that the ADP number was crap, but then we looked at the NFP number. 90% of the people are saying how good it was. All you had to do was look under the hood. Most of the jobs were created were government jobs, and average hours worked per week is trending lower, which is a precursor to job losses. I think he should be lowering rates, but if I was president, I wouldn't be calling him a dumbass and hitting him over the head with a sledgehammer.
Yeah, and let me give you a pushback a little bit on this one, because I agree with you on housing a little bit. The housing market is still rough here in Florida. It's getting worse. But the numbers that I want to talk about today are the 2025 bankruptcies so far. Bankruptcies in the United States have hit pretty much a high since 2018, and the last time we had this many bankruptcies was 2008. Bankruptcies are still picking up. I think right now we're at 371 year to date, and 2023 was 405. So we're way on pace of blowing that out. Are any of those factors affecting your idea about the market?
Yeah, I wasn't even aware of that, and that kind of bolsters my opinion that rates should be dropped. And perhaps that's one of the reasons that the 10-year didn't mind so much talk about rates being eased. I think that's very interesting. The one thing I hated the most about zero interest rate policy is that it takes away the natural Adam Smith invisible hand, which comes in and takes bad companies, knocks them out. They have to reorganize. They have to scatter to the wind and go into good companies. We had so many zombie companies that were only able to make ends meet based on zero rates. And that was a terrible position to be in, which was one of the reasons, by the way, I thought once rates went higher, that we'd see some sort of calamitous event in bankruptcies, and we did not. I was very wrong on that, but that doesn't mean we can't be seeing it now. And I think it's harder.
With zero rates, would you say that we would have better R&D? We would have more companies trying to move the technology ball forward a little bit?
Sure. With the good companies, we're doing great. I was specifically talking about the companies that were limping along, being able to borrow and live longer. But I do think there's, again, as Thomas Sowell always says, there are no solutions. There are only trade-offs. So are there good things that happen with lower rates? Well, of course they are. Those are evident. Some good companies can expand and do great things with lower rates. Some bad companies can live, and then we push it back and distort markets, and it all happens at once. We've seen that before.
Yeah, and one thing that we've been talking about a little bit is mergers and acquisitions. We just saw a big one with Kellogg this morning, like yesterday too. Are you going to continue to see big mergers and acquisitions?
I think probably that one was interesting too. I call it the carbohydrate acquisition, chocolate and breakfast cereal, all the things that you shouldn't eat for
all
breakfast.
the bad things in one place.
All the bad things. I think that if what happens going into 2026, what I believe, I think if deregulation continues, if rates don't scream higher, a lot higher, I think we will see a lot of companies with risk appetites growing and growing. I do think we're on the cusp of some sort of, animal spirit breakthrough, provided Jay Powell in the short term doesn't blow it up, keeping rates too high and letting the labor market fall apart. But I think the merger and acquisitions thing is something to watch.
People love you, Jim, and I have to ask them how you get to know you. As your newsletter out there is probably one of the best newsletters. It's the Unfiltered Investor Newsletter. If you want to, we'll give them a chance to show up and be able to click that button and subscribe to that newsletter. And listen, I've known Jim a long time now. He's on CNBC. There's a CNBC there, and how to get a hold of him on Twitter there on X. Make sure you give him a like and a follow for sure. And of course, brokerages. It's all here, man.
You're so kind to me. And I appreciate that very much, Stephen. That's awesome that you push all that stuff. And thank you guys for all the support you guys give me too. Yeah.
Jim, we'll see you right back here next week. Looking forward to some comments. And I think the comment that I want to hear about is your trip to Italy and how it went.
Yeah, that was fantastic. We'll tell them. I'm thinking about spending 3 weeks a year in Italy, starting maybe next year. Yeah,
I like that. Maybe I'll come hang out and stay at your villa, man.
The villa. Oh yeah, I was hoping to say the villa. Right? Yes.
Yeah. Thanks, Jim. We'll see you right back here next week.
See ya.